right, picture this, mate. November 1923. You're just chilling in a Berlin bakery, right? And you glance at the price board behind the counter. It's got 200 billion marks for a single loaf of bread. Not just 200 or even 200,000. We're talking 200 billion. The Sheila in front of you pulls out a wheelbarrow, not for her weekly shop, nah, but to lug enough dough just to pay for a bit of milk. By the time you finally get to the front, the baker's already crossed out the price and scribbled down 250 billion. The mark dropped 30% of its value, just while you were waiting in line for a measly 12 minutes. This ain't some sci-fi nightmare, eh? This was fair dinkum the Weimar Republic, and believe you me, it's happened a fair few times since. Venezuela, back in 2018. A carton of eggs would set you back 7 million bolivars. Zimbabwe, 2008. You needed a $100 trillion banknote just to snag a bus ticket. Lebanon, 2023. Their currency absolutely tanked, losing 98% of its worth in just 4 years. Doctors were practically broke overnight, mate. Here's the real kicker that keeps me awake at night, eh? It's not if your money's gonna go belly up eventually, it's when. On average, a fiat currency only lasts about 27 years. Our dollar's been kicking around since 71. You do the sums. So, here's the fair dinkum question, the one that really counts. When the whole money game gets chucked out and rewritten overnight, what's actually worth a cracker? I've gone through 100 years of economic stuff-ups, from Weimar to Venezuela, Lebanon to Zimbabwe, and dug up all the financial dirt. No theories, no guesswork, just cold, hard history. By the end of this yarn, you'll know precisely which 5 assets made it through when empires went bust, and which ones vanished quicker than a schooner on a hot day. Hang around. Before we get stuck into it, get this. When a currency goes pear-shaped, it always follows the same old pattern. You can pretty much predict it mathematically. First up, the government splashes more cash than it brings in. Next, they just print more money to fill the hole. Then, the currency starts losing its buying power. After that, everyone bails and looks for other options. And finally, total meltdown, every bloody time. Weimar Germany's currency went from 320 marks to the dollar in mid-1922, all the way to 4.2 trillion marks per dollar by November 1923. That's a 98% drop in just 18 months, fair dinkum. Venezuela's bolivar went from 10 to the dollar to over $1 million to the dollar in 10 years flat. And Lebanon's pound? It went from 1/500th of a dollar to 89,000 in just 4 years. Bonkers, eh? Same old story, same steps, same result. So, what actually made it through? Righto, I'll show you. Number one's a no-brainer, but funnily enough, most folks still don't have any. Precious metals, like gold and silver. They're the assets governments can't just print more of, and central banks can't muck around with. Here's the cold, hard truth, mate. During the Weimar meltdown, if you were holding on to paper marks, you lost the lot. 100% completely wiped out. But if you had gold, your buying power stayed exactly the same. An ounce of gold would still get you the same basket of goodies, whether it was before, during, or after the hyperinflation. The money changed, but gold? Nah, she stayed put. Same deal in Zimbabwe when Mugabe's lot printed that $100 trillion note. Anyone with a bit of gold was sorted. Exact same story in Venezuela. While the bolivar went to buggery, gold held its own. And we're seeing it right now in Turkey too. Data from late 2024 shows gold deposit accounts in Turkish banks. They jumped from 1.36 trillion to 2.72 trillion lira in just 1 quarter. That's a doubling in 3 months. Why? Because the locals see what's coming. Massive inflation, the currency getting trashed, and they're bolting to the only thing that survived every crash in history. Here's what the gold critics don't get. Gold doesn't actually need to do anything. No earnings or dividends required. Its whole job is just not to lose its value when money gets printed. When the supply of cash blows out, the buying power of every dollar drops. You can't just make more gold out of thin air, so it ends up being worth more by default. Back in the 2008 GFC, gold copped a hiding at first when everything dried up. But once things settled, it shot up 166% in less than 3 years. Silver did even better, gaining 448%. During the stagflation of the 70s, gold dropped nearly 50% mid-decade, hit rock bottom in 76, and then surged 440% over the next 3 years. It's a clear pattern, no doubt about it. The way it works is dead simple. Precious metals are insurance against the system failing, not a gamble. Why insurance? You hold on to them because they just sit there and keep your buying power safe while everything else goes up in flames. Number 2, foreign hard currencies. When your own dollar is going down the gurgler, the way out is holding someone else's stable cash. Take Beirut in October 2019. Imagine you're a nurse who's tucked away $50,000 in the bank after working hard for 10 years. The Lebanese pound had been pegged at 507 to the dollar since 1997. It was solid as a rock for 22 years. Then that peg snapped in August 2019. The black market rate hit 1,600 by April 2020, 3,000 by March 2021, and reached 14,000 by 2025. The official rate is now 89,000 pounds to the dollar. That $50,000 you had in pound savings is now worth a measly grand. You've lost 98% of your buying power. The number in your account looked the same, but here's the kicker. Your mate, another nurse, kept her savings in US dollars as cold, hard cash, outside the banks. She kept every cent of her buying power. Not because the US dollar was special. She could have used Swiss francs or euros. It's just because she held a currency that wasn't tanking. This happens all over the shop. In Zimbabwe, the locals started using dollars well before the government made it official. People just ditched the Zim dollar and used US cash for everything. Ecuador did the same in 2000 after a crash, and El Salvador followed in 2001. Panama's used the dollar since 1904. Right now in Venezuela, people use dollars for the big stuff, even though the bolivar is still the official money. In Argentina, you buy a house in dollars, not pesos. Over in Cambodia, the ATMs give you US dollars instead of reals. This isn't about politics, it's about survival. When the local currency fails, any sane person swaps it for a stable foreign one. The government can chuck a wobbly and mandate stuff, but at the end of the day, people vote with their wallets, eh? The big takeaway is dead set clear. If you've got foreign currency when things go pear-shaped, you're completely sorted. Someone who was holding on to US dollars during the Lebanese meltdown kept their dough. But if you were holding pounds, you copped a 98% loss. Crikey, that's not just the market doing its usual ups and downs. That's the difference between making it through and getting completely wiped out, mate. Now this third one's a bit of a head-scratcher, and it's what sorts out the blokes who get currency collapse from those who are still a bit clueless. Having a stake in proper, productive companies. You know, shares in businesses with actual assets. That's the real go. Get a load of this. It'll fair dinkum blow your socks off. Venezuela's stock market shot up more than 3,400% in 2024. The Karachi Stock Exchange went bonkers, jumping from 2,082 points to over 6,000 in just 9 trading days. Come January 2026, individual shares just went absolutely through the roof. Mercantil Servicios Financieros was up a whopping 200%. CanTV climbed 219%, and Banco Provincial saw a 171% increase. You're probably thinking, hold on a sec, the economy's going down the gurgler, but shares are going through the roof? That's a bit sus. Nah, you're barking up the wrong tree. It all makes perfect sense once you get your head around what shares actually are. A share isn't just some bit of paper. It's actually owning a slice of real assets, like factories, gear, stock, and land. When the currency goes belly up, the dollar value of those assets goes up to keep pace with inflation. Because the assets themselves haven't just vanished into thin air. Picture a Venezuelan manufacturing outfit, right? Worth $100 million in actual productive grunt. So, when the exchange rate shifts from 10 bolivars to the dollar to 30 bolivars to the dollar, the share price goes up. It jumps from 1 trillion bolivars to 3 trillion bolivars. Not because the company's suddenly worth more, mind you. Nah, it's just because you need more bolivars to match the same amount of US dollars. But here's the crucial bit most people miss, the real kicker. Not all shares make it through in the same shape. Only businesses that have their income coming from outside the collapsing economy manage to hold on to their actual value. A company that's raking in all its cash in bolivars will see its actual profits go down the drain, even if its share price looks like it's going up. See, it's got to swap those dud bolivars back into dollars just to grab stuff from overseas. On the flip side, a business that sends half its stuff offshore gets its dollar earnings straight up. Its bolivar expenses actually drop in real terms, while the dollar income just sits there, steady as a rock. Real profits get a boost when the currency goes down the gurgler. For the shareholders, it's a proper inflation shield, fair dinkum. Studies into the Latin American bust-up in '82, Mexico's peso drama in '94, and Asia's big stack in '98 all back this up. Direct investors running factories that could shift sales from local punters to overseas buyers, well, they didn't just survive. They absolutely cleaned up. Other types of investments went completely pear-shaped, diving into the red. The main thing was being able to export, simple as that. So here's the go. Productive shares that pull in cash from all over the world aren't just hanging on by a thread. Nah, they actually do pretty well out of a currency collapse. But companies that only deal locally? They go down with the ship, mate. If you're realizing everything you reckoned about keeping your money safe is a bit off, then chuck us a subscribe, eh? This channel's all about financial detective work. I'll show you the guts of it, so you can spot the patterns before they pop up again. And it won't cost you a cent, unlike trying to get financially savvy in a system that's set up to keep you in the dark. Righto, let's get back to the stuff that hangs around when cash kicks the bucket. Number 4. Everyday bits and pieces, and things you can swap. This happens when the proper money system completely goes belly up. Economic activity doesn't just pack it in, it just finds new ways to swap stuff around. After World War II in Germany, the Reichsmark was so utterly useless, they pretty much just chucked it in. Folks were swapping their goods for smokes, coal, and spuds. Smokes really stood out as a temporary kind of cash for a while there. Yank soldiers grabbed smokes from the army shops for next to nothing, and then swapped them with the Germans for goods and services that were worth heaps more. Why smokes, you ask? Well, standard packs, easy to break up, don't go off, light as a feather, and everyone took them. They worked exactly like cash, just without the government stamp on them. Black markets by the big German train stations would open round the clock, swapping everything from train tickets to dodgy IDs using smokes as currency. Check out the proof. Whenever heaps of Red Cross parcels showed up at the POW camps, it'd flood the place with smokes and send prices sky high. It's just like printing more money. More fags chasing the same stuff means the cost of everything goes up. Fast forward to Venezuela in 2018. When the bolivar went belly up, locals just started swapping goods directly. Fishos traded their haw for flour to feed the kids, swapping things that actually mattered like meds, tucker, water, fuel, and tools. When the supply chains copped it, even things like bog roll, soap, and wet wipes became worth their weight in gold. It wasn't about being comfy. It was about staying healthy. Keeping clean stopped bugs from spreading when everything else was falling apart. But there's a catch. You eventually use up your consumables. They aren't much chop for holding onto your wealth over the long haul. You can't really build a proper nest egg out of aspirin and batteries. They're good for a quick fix, but not for a long-term plan. The best bet is to keep a little bit aside in physical basics, just so you've got something to swap when things get really hairy. But most of your wealth needs to be in stuff that doesn't disappear the moment you use it. Number 5. A bit of farmland. It's the one asset that stays put and grows the stuff we literally can't survive without. Tucker. Back in the Great Depression, the farmers had a much better run of it than the city folk. The benefits of being on the land were pretty clear and couldn't be ignored. Farm families grew their own veggies and bottled fruit from their orchards. They got their milk and cream from the dairy cows, and chooks for meat and eggs. They could easily get by without new clothes or fancy consumer stuff. But there was one fair dinkum tough hurdle they had to clear. They still had to cough up cash for taxes and what they owed the banks. This same old story pops up whenever things go pear-shaped these days. Over in Venezuela, the blokes with farmland could still churn out tucker. Didn't matter a jot what the currency was doing. But those with city commercial property had tenants who couldn't stump up the rent. When you boil it down, land gives us grub. City property, on the other hand, just brings in rent in a currency that's going down the gurgler. Grub wins out, but here's the crucial bit. Farmland's got some serious weak spots, though. First off, it's completely stuck. You can't shift it, and you can't flog it off quick smart if the political scene goes sour and owning it gets dodgy. You're well and truly rooted. Back in Zimbabwe in 2000, Mugabe's land grab just ripped up commercial farmers' property rights, just like that. Farms got divvied up with no payout, flash operations were wrecked, and farm production plummeted 60% in 10 years. The total value of those farms dropped by a massive 75% just between 2000 and 2001. Second weak spot, taxes. Someone with city commercial property in a currency that's tanking might have to sell it for peanuts, just to scrape together enough for the property rates. Land can't do a runner. Governments know exactly where it is and can tax it till it's worth bugger all. Thirdly, farmland that grows stuff for export is way better than land just producing for local tucker. Export crops fetch stable currency. Local crops just get you a local currency that's going belly up. So the game plan is, own land that's either productive and can bring in export dough, is outside the area of the dodgy currency, or is held through a company setup that keeps it safe from being grabbed or directly taxed. Farmland holds its basic value because it can grow tucker, but it's not as easy to sell off and more open to government meddling than gold or shares you can move around. Righto, let's chat about what goes bust, because knowing what tanks is just as crucial as knowing what makes it. Top of the list, no worries. Fixed income stuff. Steer clear of bonds in the currency that's collapsing, government notes, or anything where you're owed money by a state that's on its last legs. Back in Weimar Germany, folks with government bonds in marks watched their whole investment go down the drain. It happened because the marks meant for paying back the interest and principal basically vanished into thin air. In Argentina back in 2001, bondholders copped a 70% cut to their nominal value during the debt restructuring. Even that smaller amount could only be grabbed after years of battling it out in court. The real issue is that fixed income securities are just a claim against a currency that's currently falling apart. Once the currency tanked, the claim wasn't worth a cent. That's not a market glitch, it's just what happens. Second on the list, savings accounts in the local currency stuck inside a dodgy banking system. Deposits in Lebanon held in pounds lost over 95% of their worth as the pound's value plummeted. The rate blew out from $1,500 per dollar all the way to $89,000 per dollar by 2025. Bank customers who put their savings into pound deposits in 2019 only had 2% of their original buying power left by 2024. The dollar figure stayed identical, but the actual value evaporated. History makes it pretty clear. Lending money to a failing state is the quickest way to see your entire wealth destroyed. So, where are we spotting these red flags at the moment? Spotting patterns only helps if you can see the setup before the whole thing kicks off. A massive financial wreck is unfolding right now because there's just no cash liquidity around. Over 70% of the money supply has dried up because of banks capping withdrawals of the dinar. The currency crashed from 190 per dollar to unofficial rates near 1,750, proving people don't trust banks and are smuggling cash. That's classic Stage 3 conduct. Gold deposit accounts in Turkey more than doubled in one quarter as locals scrambled for precious metals. That's Stage 4, crazy inflation and currency debasement. Currency substitution is starting. Lebanon's currency copped a 98% collapse, and their banks are basically broke. That's Stage 5, total failure. And then we've got the massive issue nobody wants to mention. The US's $38 trillion debt, with a debt-to-GDP ratio growing out of control. Crikey, interest payments on our national debt are now bigger than what we spend on the military. And get this, the US dollar slice of global foreign exchange reserves has dropped from 80% back in the mid-70s to 65% today. That's the same track Britain's sterling took when it went downhill as the world's top currency. Back in 1913, Britain was the world's biggest lender, right? But within 40 years, they were in the red, owing more than they were owed, and the dollar took over from sterling. You can totally see the pattern if you're keen to have a squiz. Alright, so here's the hard yakka truth. Currencies chucking a wobbly isn't just a what-if scenario. It's actually what usually happens throughout history. On average, a fiat currency only hangs around for about 27 years. Struth, 99% of all the currencies that have ever been invented are now completely gone burger. It's not a matter of if your currency will go belly up. The real question is whether you've set yourself up to ride it out when it inevitably does. Righto, here are the 5 assets that have made it through every single collapse since 1923. First up, precious metals. They're the go-to, universal way to stash your value. Then there are 2 foreign hard currencies, like an escape hatch. Productive shares that earn export dough. They're the ones who clean up when things devalue. Consumables and stuff you can barter. That's your tactical cash when systems seize up. And agricultural land. That's your Tucker generator. Now for the assets that went completely bust, fixed income stuff in local currency, credit that just wiped out too, and savings accounts in a currency that's tanking, that's your purchasing power going straight down the gurgler. The big takeaway isn't to ditch all your local assets, mate. It's not about turning into some doomsday nutter stashing gold in a bomb shelter. The real lesson is that proper diversification means you've got to hold different kinds of value that react in their own way when the money system goes pear-shaped. If your whole portfolio is just shares in one country, you're looking at a massive risk if that country's currency takes a dive. And if your entire portfolio is made up of bonds in a currency that's going down the drain, well, that's just going to get wiped out. A truly diversified portfolio, mate, should have some precious metals as a bit of insurance, foreign currency assets to guard against specific currency risks, productive shares with income coming in from overseas, and maybe even some real assets in places that are pretty stable. The current warning signs over in places like Iraq, Turkey, and Lebanon reckon that currency crises are still a fair dinkum possibility. The US dollar's still looking pretty steady, but history's got stacks of proof that you can't just assume it'll stay that way forever. No worries. The smartest way to go about it isn't to chuck a wobbly. It's to spot the pattern and get yourself sorted out properly. Having enough diversification across different types of assets and countries means that no single stuff-up can completely wipe out your purchasing power. History's got all the answers, mate. You just gotta be keen to have a good look at the post-mortem. Get onto this before you end up being the next example they talk about. If this deep dive into the numbers gave you a fresh way to suss out economic risk, then chuck us a subscribe, eh? Chuck a chopper emoji in the comments if you're already getting set for what's heading our way. I have a squiz at every single one, and just remember this, mate. The pattern's all mathematical, and you can pretty much predict it. The only real question is whether you'll spot it coming, or just be stuck in the queue at the bakery. Are you scratching your head wondering how bread ended up costing 200 billion marks? Cheers for watching, legends. Now go diversify your stuff before you're forced into it.